Hi and welcome to Westpac's videocast on July the 7th, Thursday, from Westpac's London office. Well, it's been a pretty interesting day today. A few key events to report. The European Central Bank lifted interest rates by 1/4 point to 1.5%, as widely expected, although a move that has been criticised by many is really not appropriate given the state of the European economy and financial markets. Also, the European Central Bank confirmed that it will accept the government debt of Portugal as collateral for loans to Portuguese banks, even though Moody's have now downgraded the rating on that, the credit rating on that debt to junk status with a negative outlook. So that's basically a bending of the rules, much like they did with Greece some time ago. I've got to caution that although it sort of buys time and helps keep the Portuguese banks afloat, who are very much dependent upon funding from the European Central Bank, it does actually expose the European Central Bank actually to significant losses down the track if indeed we do see a debt restructure or even a default by these governments. It's one of the reasons why the ECB is so against the idea that creditors should wear any part of the burden related to sorting out the European sovereign debt problems. Our view at Westpac is that the only way this thing can be solved is by creditors sharing some of the pain. So we just have to see how that pans out over time. The other major event was a stronger than expected private sector jobs report out of the US. ADP reported a 157,000 increase in private sector employment in the month of June, up from a much weaker 36,000 outcome back in May. June's number was still the second weakest for the year. I mean, employment growth has still slowed since the first 4 months of this year, but nevertheless it was a stronger than expected outcome, and it suggests that the labour market mightn't be melting down quite as quickly as some of the figures we had been seeing for May had been suggesting. This is an important number too because it comes ahead of tomorrow's official employment release for the US. We're still a bit cautious on that one. We're looking for a 65,000 increase in the official measure of employment for the month of June for the US, 80,000 private with a 15,000 loss on the public sector side. And with unemployment to remain around 9.1%. The other numbers today, we saw initial jobless claims a little bit weaker in the US. That's a measure of the extent to which people are being laid off. Another slightly positive labour market indicator to come out of there. Bank of England left interest rates on hold. No surprise there, no statement issued by them. Moving on to markets, we've got a very positive equity market story today. That's basically based on the positive market reaction to the decision to accept Portuguese bonds as collateral by the ECB and the stronger than expected jobs numbers in the US. So the Dow's currently up 0.75% at 12,719. Average gain on European markets is almost 1% heading into the close there, with the FTSE actually up more than 1%. So pretty decent gains on equity markets have translated into positive sentiment in commodity markets, where we've got some pretty decent price gains coming through. Just mentioned shugg up 6% for you guys up in Queensland. Copper prices up more than 2%. Oil's up 1.8% today at $98.40 a barrel. But gold is little changed. It's at $1,529 an ounce. In terms of the Aussie dollar, it had a bit of a bounce on the reasonably solid jobs numbers reported on Thursday your time, and it's had another leg up from this positive sentiment in equity and commodity markets that we've seen at the moment. And the Aussie dollar is now trading around 1.075 against the US dollar, from a little bit below 1.07 yesterday. No major Aussie news to watch out for today, so the next big thing is that US non-farm payrolls report coming out Friday night, Australia time. Those jobs figures for the US, the most important indicator of the month, but in my view, actually one of the least reliable indicators of what's actually going on in the US jobs market. But more about that tomorrow.